Hello. Today we'll be looking at a couple case studies relating to internal control. More so, we will be looking at the devastating consequences that occurred due to a failure in internal control. We'll be looking at case studies which have accounting scandals or specific problems that emerged due to not following auditing standards. And finally, we'll also look at what preventive measures could have been taken.
Let's move to Suryansh with the first case study.
So good morning everyone, my name is Suryansh Sawant and today we are starting the case study section of Audit. Enron Corporation was once applauded as being one of the most innovative companies in the United States. It's headquartered in Houston, Texas, and it grew from a regional pipeline operator into an international energy and commodities trading giant. Its business model depended significantly on company financial instruments and aggressive accounting schemes. But in the late 2001s, it was disclosed that Enron had been involved in huge accounting frauds, concealing billions of dollars of debt in off-balance sheet entities, which were basically the special purpose entities, SPs. The company went bankrupt in December 2001, leading to massive losses for its shareholders. Now let's look at the key players involved in the scam. The Enron scandal revolved around its top executives, CEO Jeffrey Skilling and Chairman Kenneth Leigh Foster, a corporate culture that gave higher importance to stock performance in the short term than to moral business. And IAF-A Andrew Fasto created and oversaw a system of special purpose entities, as we talked about earlier, utilized to conceal Enron's debt and inflate its revenues. Arthur Andersen LLP, which was the external auditor of the firm, one of the largest audit firms in the world, served as Enron's external auditor but failed to raise concerns and ultimately destroyed the audit documents. The actions and inactions of these key figures played a central role in enabling this scam. Now let's move to the internal control failures. One of the main reasons for Enron's collapse was the failure of internal controls. These controls, which are meant to protect the integrity of the financial reporting standards and legal compliance and operational effectiveness as even, were weak or certainly bypassed. The governance framework of the company did not provide proper checks and balances, and wrongful accounting procedures were unchecked for years. The board of directors and the audit committee at Enron were completely ineffective in their oversight, although they were aware of complex financial arrangements such as the SPs and market-to-market liability strategies. They were too dependent on assurances from effective management and lacked the exercise of their fiduciary duty to shareholders. The board also sanctioned Foster's dual position as CFO and SP manager, which was a big conflict of interest in the company. Now let's move on to the main topic, conflict of interest. One glaring internal control deficiency was the conflict of interest with CFO Andrew Fasto. He set up and controlled SPs that did business with Enron. Basically, this enabled him to be on both sides of the business. This setup allowed him to craft deals that profited him and masked Enron's financial situation. This was actually very, very weak. There was no independent monitoring or review system to detect or deter such self-dealing, which indicates an absolute breakdown in ethical and governance standards. Enron did not have adequate segregation of duties, a bedrock of internal control systems. Those who developed financial strategies also authorized and reported them, which is again another conflict of interest, eliminating all the checks that were required to provide objectivity and transparency to the shareholders. This enabled financial data manipulation since there were no independent reviews or internal audits to confirm the accuracy and validity of the financial statements. Okay, now let's move on to the misuse of special purpose entities. SPs were basically designed to effectively reduce and to some extent remove the financial risk of Enron. But Enron used them to disguise debt and construct false profitability. It involved large transfer of liabilities to the companies. The company were employed to remove liabilities from Enron's books and provide a misleading picture of good financial results. In most instances, Enron guaranteed the obligations of these SPs, but these assurances were concealed from investors and shareholders. This misrepresentation was made possible by weak internal controls and even weak external audit system, in which the company could go on to continue misleading the market and window dress the financial statements. Moving on to ineffective internal audit. Enron's internal audit function was not independent, well-reserved, nor adequately empowered. It was closely controlled by top management and did not have the will or ability to question their decisions and doubtful transactions. Consequently, the internal audit function did not identify significant red flags like the repeated use of SPs and transferring a high amount of liabilities to them, and the overstatement of asset values, which increases and inflated the revenues of the company. This permitted fraudulent activities to go unchecked and supported a culture of non-transparency. The internal audit function needs to be strong enough as to generate some amount of trust by the external auditors. Audit failure and complicity. Arthur Andersen, which was Enron's external auditor, was primarily involved in the scam. The company earned huge consulting fees from Enron, which was supposed to be lesser than their audit fees, which undermined its independence and objectivity. Andersen was also involved in the internal audit, which is supposed to be completely separate from the external audit function. Andersen not only signed up on questionable accounting methods such as market-to-market valuation of long-term contracts, but also even shredded audit records once investigations were underway. Their inability to maintain professional and ethical standards was a major reason for facilitating Enron's fraud and resulted in the company's criminal conviction and eventual dissolution. Next, we have consequences of the scandal. The Enron scandal aftermath was disastrous on the investors. Shareholders lost more than $74 billion and a lot of employees lost their jobs and pension funds. The scandal also produced a general decline in confidence in corporate America and even the accounting business. Several executives were prosecuted and sent to prison, and one of the big five accounting companies, Arthur Andersen, went out of business. The scandal revealed inherent vulnerabilities in corporate governance and financial regulation and led to various reforms and regulation transformations in the United States of America, primarily the Sarbanes-Oxley Act. Next, we'll move on to the ISA violations. ISA 200, which says overall objective of the independent auditor in the conduct of an audit. The overall objective of the internal auditor was to identify the issues in the books of financial statements, which it failed to do. ISA 315 says identifying and assessing the risks of material misstatements. As clearly shown, the huge transfer of liabilities to the special purpose entities was a clear misstatement in the accounts of Enron, and this was failed to be identified by the internal and external auditors. Next is ISA 230, which is audit documentation. This was clearly violated, as you saw here, when the external auditor Arthur Andersen shredded the documents made by the audit firm. ISA 500 says audit evidence. This again moves to the destruction of audit documents and evidences by Arthur Andersen, that is the external auditor. Then we have ISA 240, which says the auditor's responsibility related to fraud. This ISA was clearly violated as both the internal and external auditing firms were unable to identify the fraud and failed to report it to the management and the directors. The last ISA is 265, which is communicating deficiencies in internal control. The internal control was very weak of Enron, and the internal auditors failed to convey this to the directors or the management, and even the external auditor, which is Arthur Andersen, failed to deduct this internal control issues.
Wishing you a good day. Myself, Harshdev Singh, and I will be doing the presentation for internal control of the audit. And my slide number starts from 03 and page number 18. And my company will be Vedanta Limited. And I will be doing the audit. I will be doing the topic internal control for the audit. So what I will be doing is like linking the internal control of audit and the Vedanta. So how the Vedanta does the control, provides the internal control of an audit. So basically talking about Vedanta Limited. So basically talking about the introduction of the Vedanta Limited. It is a company which is based on resources extraction. What it extracts is the oil, minerals and gases throughout the country. And the company has a robust portfolio in oil and gas exploration and production. That's what I said. And the case study which I will be talking relates to the financial statement of March ending on the March 31st, 2024. So basically what we will be talking about is the consolidated financial statements. And the purpose of an audit is to basically do the audit, means to check the financial statement. It could be done by the external party or the internal party. Both of them can do it. And external one is the mandatory one actually, as per the rules. And for having the audit, it is necessary to have the consolidated financial statements. And Vedanta is not just focused on financial performance, also deeply committed to sustainable development. As we live in a world where pollution is thriving every day, and especially the Pune is a very much polluted city, air pollution is very much high. So Vedanta is a company which talks about the sustainable development, as the ISA 720 deals with. The sustainable development is like doing the development, but matching with the future needs, not compromising with the future needs. Okay, so I will be moving forward. Audit opinion. So basically, what audit opinion is, every company needs its own auditing. So if every company will do its auditing, we will require a proper standard, having a proper standard which is regulated by a proper regulatory authority. So basically, ISA is the International Standards of Auditing, which deals with the auditing. We deal with the proper standards like ISA 210, 220 and 300, and we have some ISA 200, 210, 220 and 300. So basically we have different types of ISAs, and I will cover the topic from ISA 200 to 300. Overall objectives of the independent auditor: conduct of an audit in accordance with international standards of auditing. So basically we have an international standards of auditing throughout the world, and which provides a link. So basically if a company was to have an audit, it could actually link throughout the world, and so we can have a proper statement, not having any cohesion, not having any kind of I can say jargons in between. So it will be easier for the even the external parties and the internal parties. So work could be done much more faster. That's what I'm meant to say. And I said agreeing the terms of audit engagements. And ISO 220, quality control of an audit of financial statements. So basically, every company makes its own financial statements, which constitutes of profit and loss account, balance sheet, and working notes to accounts throughout, which are made through audit. And we need to have a proper standard for making financial statements, and through which we can actually make financial statement which could be comprehended and which could be used by the customers as well as the shareholders. So basically, that's what auditing does. It makes a proper rules and guidelines so that everything would work in a cohesion, not having any kind of lack of coordination and kind of things like this. And ISA 300, planning an audit of financial statements. So the audit would be planned, and the financial statements, before anything we need to have a proper plan for it. And so basically ISA 300 deals with it. It deals with the proper planning of the audit statements, of the audit which we are going to do for the financial statements. And so basically we will be talking about the key audit matters. And we are going to cover some 3 topics inside of it. First one would be the related party transactions. Second would be the recoverability of the assets. And third one would be the disputed trade receivables. Number one is number A, the related party transactions. The group engaged in significant transactions with related parties, raising concerns about proper authorization and disclosure. Reviewed groups policies on the related party transactions, tested transactions against underlying contracts and supporting documents, assessed management's evaluation and external expert reports. So basically what it deals with is, you are required of proper authorization and disclosure of the papers throughout the dealing with the transactions. So basically when you talk about the Vedanta is a company which deals with mining, extraction and the things. And the thing would be that it would be required of financial statements throughout dealing with the contracts and throughout dealing with its revenue. So basically it would be required of a proper statement which is solidified and as well as it has a proper authority. That's what it says, related party transactions. And the point B would be the recoverability of an assets. So basically for a company, like when we talk about the balance sheet, we have current assets, and inside of the current asset we have the trade receivables and some other receivables. So basically it deals with the assets. If I have money, if I have lent it to someone 100 rupees, and if he was to give us 100 rupees, he owes me 100 rupees, it would be my asset because it would be benefiting me in future. That's what asset is. And so for a company to recover its assets is very much essential. And focus area Our focus area in this would be the audit concentrated on the recoverability of property, plant and equipment, particularly in the copper and oil and gas segments. And the procedure for doing the audit would be evaluated impairment indicators and management assumptions regarding the future cash flows. Whatever the future cash flow will be, we will be doing we will be having proper impairment indicators and management assumption that this will be the things which will be happening in the future. Like if I was to have a proper asset, if I was to purchase a property or plant or equipment, not property but plant and equipment, it would be having depreciation on it and some further maintenance and impairment charge for which we have to make an assumption on it, and that's what the recoverability of the assets is. And disputed trade receivables. Obviously, if I have lent him 100 rupees and he's providing me with, but if due to some circumstances he's not able to provide me 100 rupees, and that would be known as disputed. So what we are talking about is the disputed. And the disputed receivables in the power segment pose a risk due to ongoing litigation and regulatory disputes. As to have a proper regulatory body, it will be very much required to not have disputes, not to have any kind of concerns with other external parties. Basically, it can lead to cohesion between inside of the company, and it is very much essential for a company to have those financial assets with them. And audit procedure. Review power purchase agreement and regulatory rules. So whatever things which we are purchasing or the things which we have which we would be receiving as a trade receivable, they need to be reviewed again and again, and there should be a regulatory unit for it. Now I will shift into the new topic, internal control assessments, and inside of it are 3 topics: control environment, risk assessment, and monitoring activities. And I will be dealing with the first topic, control environment. The policies and procedures. The group has established policies for identifying and managing the related party transactions, asset impairments, and disputed trade receivables. Basically, internal control assessment. Assessment means to check the things, to have a proper validation, to check whether it is right, it deals with the proper laws and regulations or not. And so for the control environment, it means to have a proper environment in which you can control the things, in which you can have the proper auditing for it, in which you can do the proper things for auditing, and it relates with the proper international standards of accounting, auditing. Approvals from the board and audit committee for related party transactions. So the activities which should be done inside it would be the approvals from the board and audit committee for the related party transactions. So basically, Vedanta is an extraction company. It will be dealing with the various kinds of rigorous transactions with government and also with the semi-government, and also obviously with the private sector. So basically, it needs to justify about its transaction which it deals, and that's what the internal control is. A clear organization structure which defines roles and responsibility helps ensure accountability and effective communication within the firm. Clearly defined authority and the responsibility for the internal control activities help ensure that employees understand their roles in maintaining effective controls. And risk assessment, so for an audit, the identification of the risk. If a company is posing so much risk, like example, if Vedanta will be taking a loan of $100 million or बहुत ही बड़े amount का लोन लेते हैं, and if they are in a position that they won't be able to pay, that's where auditing comes in between. So basically, that's what I want to link it. Auditing means to basically checking the financial statements and having a proper record of it, whether the company is dealing with the proper, whether the company is moving in the right direction or not, or whether the company is performing good or performing not in a good way. Management implemented controls to mitigate these risks, which are evaluated during the audit. Vedanta should regularly review its compliance processes to ensure they meet the laws and standards. This not only helps in avoid potential legal issues, but also reinforces company's commitment to ethical practices. And ultimately, monitoring activities. As everything requires its own feedback. So basically you can improve those activities. That's what monitoring activity means. For doing the auditing, it would be essential to have proper feedback, to have proper things through which you can improve your art. So basically Vedanta deals with so many transactions because it is an extraction based company. It needs to extract the resources and then do the work. So basically Vedanta will be required of having a proper documentation, and as the man here says, some areas will be required of improvement, particularly in documentation and authorization processes. The internal audit team provides the regular reviews and whatever they can do. That's what I said. The company can do its review of an audit from basically external or actually internal parties. So external parties would be the audit, and external parties would be the auditors, which could be anybody who is certified by the either CA foundations or ICAF or CMA or any kind of having a proper degree from regulatory body of India for the accountants. By doing the internal review again and again, they are able to provide internal insights in how the company is managing its risk assessment as well as also having its control environment. So basically all of it things comes under the environment which the Vedanta is designing to have proper auditing for its firm. And auditing is a very important function according to this conclusion. Now we are coming towards the end, but it will be the beginning for me to have a proper insight in having the auditing, how the auditing works in an organization, and how auditing is a very important function according to me. Throughout the session, I was able to understand that auditing, through auditing you can understand how the company is doing its financial performance and how the company is related, as this slide says. Related party calculation. You can see if this was to be Vedanta, it would be dealing with the various companies and organizations. That's what I need to say. And for coming more towards the conclusion, now we have a little bit of ability to do the auditing for the firm. And recommendations, the continuous improvements in the internal control processes, particularly in documentation and compliance with the regulatory requirement, is essential for maintaining the integrity of financial reporting. So basically to report the financial statement, it would be required to have proper documentations and have proper things. And Vedanta can make it easier for its customer and shareholders, because what the Vedanta lacks is like having proper documentation, reviewing it again, and having an environment for it. It means having a structure which there would be a proper review and they would be dealing with again and again.
Now, let's take a look at case study number 3, which is Ryco India's falsified accounts. Ryco India is a subsidiary of the Ryco company situated in Japan. It's a multinational corporation known for its advanced office and imaging solutions. It was founded in 1993 and it focuses heavily on the technology sector. It provides services for various business and sectors such as healthcare, education, and government. Now, the main scandal. In 2016, Ryco India admitted that its accounts had been falsified and an estimated loss of over 1,123 crore rupees for the fiscal year ending March 31st, 2016. Now, when exactly were these accounts altered? For the years 2013-14 and 14-15. Now, because of this fraud, the CEO and CFO of the company resigned and SEBI launched an investigation and imposed a fine of 31.5 crore rupees on the company in 2017. Let's take a look at the company's internal control system. Now, its internal control system is designed to ensure compliance with the laws, accuracy, reliability of financial statements, and to promote operational efficiency. Now, it consists of the board of directors, audit committee, and top management. Now, a lot of scrutiny is given to the IT systems of Ryco as it focuses on technological services and requires a high level of security as discussed before. Now, after the 2016 fraud, the internal control system has been through major changes and with much stricter rules because of the fraud which changed the company's reputation in the Indian market. Moving on, falsifying accounts. In 2016, the Ryco India was at the center of a big accounting scandal, and when it was discovered that Ryco India has been falsifying its books for years. Now, the key problems were inflating revenue numbers, overstating receivables, and understating expenses. And as per the results of Ryco India's own internal discrepancies began with the firm inflating its revenues by including sales that have not yet been completed and even some totally fictitious transactions, imaginary, which has not yet occurred. Now, the company manipulated its receivables by reporting them either in whole or in amounts likely to fail to materialize. This information on the balance sheet also leaked to expenses as reported, and those were withheld or undervalued intentionally. The result was a major spike in profitability. Now, the financial results were altered in the year 2014-15 and 15-16, which made both these years' accounts completely unreliable. Discovery and investigation of the fraud. How was this fraud discovered? The problem was initially brought to RICO India's external auditor, who detected some discrepancies in the internal auditing books. In the course of this inquiry, RICO India's management admitted to falsifying sales figures, manipulating receivables and misrepresenting expenses. It was found that the falsification of accounts was linked to the top executives who were under pressure to meet growth targets set by the parent company in Japan. We'll get back to that later. As the probe went on, it became clear that such fraudulent actions were not isolated occurrences, but systematic issues in the internal control system and the financial reporting procedures. Let's move on. Consequences for RICO India. What exactly happened after they discovered this fraud for RICO India? First of all, they revealed losses of over 1,123 crore rupees. And SEBI had launched a series of investigations into RICO, and it discovered multiple violations over and above the falsified accounts. Many top-level officials faced resignations and regulatory actions. RICO India's shares were barred from the BSE and NSE stock markets, and in 2020, they completely voluntarily withdrew their shares. Now, the fraud led to many investors and shareholders losing their trust in RICO and their company's reputation going down. Their sales took a major hit, which ended up disrupting production. The causes of this fraud. Why exactly did this fraud occur? Let's take a look. Management at RICO India had external pressure in order to meet performance targets. Being in a competitive market like India, this was a difficult task. This was basically from the top executives of their parent company in Japan. RICO India's internal control system can be considered a weak one with less checks and a lack of security, which is obvious. Management was heavily involved in the fraud. They breached the code of ethics, lapsing in integrity and honesty for their own personal gains, which is a heavy breach of honesty and human values. Lack of corporate governance can be considered a major cause. Related ISAs. What international standards of auditing are related to this cause? Now, ISA 230, audit documentation, ISA 240, the auditor's responsibility relating to fraud in an audit of the financial statements, ISA 265, communicating deficiencies in internal control, ISA 315, identifying and assessing the risk of material misstatements, ISA 500, audit evidence. Now, this is a photo of RICO's logo and its center, headquarters in Tokyo. Conclusion. The RICO India accounting scandal in 2016 is a reminder of the importance of corporate governance and the effective internal controls and ethical leadership. Not only did the manipulation of accounting records cause huge financial losses and regulatory problems, but it also caused irreparable damage to the company's reputation in the long run. Now, it shows how a combination of poor management, poor internal controls, management pressure, and ethical shortcomings can prove disastrous for an enterprise. It also highlights the need for organizations to have proper oversight in place and a proper internal control. On to the next case study.
So I'll be presenting the Toshiba accounting scandal. It is a little bit similar to the Enron accounting scandal that my peer Suryansh presented. So let me give you a brief introduction. The Toshiba accounting scandal was uncovered in 2015 when an independent investigation into the company revealed that their profits overstated by almost $1.2 billion over a seven-year period. The misstatements were part of an intentional overstatement of profits to satisfy performance to target by the upper management of the company. The senior executives applied pressure on junior level executives and accountants to manipulate their accounting records in order to show inflated profits and hide their losses from any stakeholders. Due to this, a culture was created where such unethical behavior became a standard, and any disagreement from the employees was silenced, and also showed the fact that whistleblower policies were not encouraged. And the scandal did not only shake the corporate world of Japan, but also raised much broader concerns about regarding corporate governance and in Japanese firms and the standards at which they are worked at. Toshiba's internal controls were then scrutinized by the public by enforcing regulatory and legal consequences alongside inflicting serious damage to their reputation and their business. So now let's look at who was involved. At the center of the scandal, the top leadership of the company was involved, and the management provided either direct support or were in the background support to cook the books. The main key players were the CEO, Isao Tanaka, the vice chairman, and former CEO, who were variously involved in either encouraging or or silencing any upcoming responsibilities or fraudulent activities. The ones involved exerted immense pressure throughout the years on junior management and accounting staff to quote unquote find profits in their books and meet whatever performance target they had set for that month or that year, regardless of what had actually occurred. Due to this, employees lived in a constant culture of fear and obedience, in which questioning directive from the top management or the CEOs was simply not tolerated. An internal audit unit did exist, however, due to a lack of independence, it lacked authority with senior management sidestepping each and every rule or findings made, and on many occasions. Audit committees and board of directors failed their primary mandate, which is to avoid any final misstatements, and if found, to report them. And media criticism and reputation of Toshiba was loss was directed at Toshiba's external auditors, E&Y, Shinhan, for the inaction or failure to detect the long-standing fraud. So let's look at the internal control deficiencies within Toshiba. Toshiba's internal control deficiencies were widespread. There was an evident lack of independence in the internal audit function, and risk assessment processes were either weak or ignored entirely. Due to this, policies for financial reporting were very unclear, and documentation was either lacking or not enforced. Most importantly, Toshiba lacked a whistleblower-friendly environment, due to which employees feared retaliation and remained silent even when they spotted irregularities. These issues highlight how an ineffective internal control system makes it easy for fraud to go undetected for years, even with statutory auditors. The issue occurred due to the internal audit function not being independent from the managerial pressure, and we're not able to function efficiently or effectively due to suppression from higher officials. The communication and information systems were already compromised due to, as within the organization, they were not such that they could maintain transparency, and they could not provide any clear communication over their existing communication systems. Let's look at a breakdown of the control failures. One of the major issues was improper revenue recognition, as it recognized future revenue before inflating the profit. The second point was that Toshiba's infrastructure project costs and the costs associated with its semiconductor business were underreported, and loss-making projects were misaccounted for, meaning they were not showing any loss-making projects in their books. Managers were told to change their numbers without any supporting documents just to meet the target, which meant that the stakeholders were misled and forced to believe that the company was doing well. Manipulation of estimates made projects look profitable and more desirable, and there was no effective mechanism of reviewing to question such estimates or challenge their underlying assumptions. The culture within Toshiba discouraged any whistleblowing and disobedience. Employees, as I've mentioned before, employees feared for any retaliation, and the board and audit committee failed to exercise their supervisory function. The board, audit committee, and the statutory auditors failed to exercise the supervisory function and accepted the financial accounts at their face value without any further scrutiny. This illustrates any internal control function, ethical conduct, and supervision breakdown so deep-rooted that they became part of maintaining accurate and reliable financial reporting. The consequences of weak internal controls were severe. Once the scam was revealed, the stock price of Toshiba plummeted, key executives were made to resign, and the company also had to revise several years of financial statements. The company suffered many financial damages, but also suffered a huge loss of their reputation. The company was further also made to restructure their entire operations. Let's look at how the ISAs were violated in this specific example. First, ISA 315, which is underlying and identifying the risk of material misstatement. This existed due to fraud and was inadequately performed by auditors and corporate governance structures. The second one is ISA 240, which describes the responsibilities of auditors for fraud consideration. And this was violated since there was no evidence showing professional skepticism and the insistent failure to investigate further into the red flags. ISA 265 was also present, where significant deficiencies in controls were not well communicated to those charged with governance, which in this case would be the audit committee and the stakeholders. ISA 330, which requires auditors to respond appropriately to assess risks, which was not implemented. Now, the key point to note from this is that the existence of evidence pointing to the manipulation of financials and no specific audit responses were designed or executed. These lapses offer a chance to show how the failure to comply to ISAs, and especially those pertaining to fraud risk and internal control deficiencies, can lead to audit failures. Now let's look at some preventive measures that Toshiba could have taken. Well, several measures could have been taken to prevent the scandal. First, a stronger tone from the top executive was essential, as executives should have promoted ethical behavior and discouraged manipulation. However, in this case, that is exactly where it started, and with the hierarchy of Japanese firms, where it is more top-down approach, the junior level executives were forced to comply to any and all requests made. Second, establishing a more independent and empowered internal audit committee could have detected fraud earlier, and also showed the path for statutory auditors when they were auditing. Regular training on compliance and ethical reporting paired with effective risk assessments would have helped create a more transparent culture within Toshiba, and maybe prevent this entire scandal altogether from the year one itself. Most importantly, Toshiba needed a functioning whistleblower mechanism or a policy that would have allowed employees to come forward without any hesitation or disregard for any reprimand, and to report misconduct without any fear. Now, these are just some ways that Toshiba could align themselves with the ISAs. In light of the ISA violation by the company, they must ensure that internal controls align with any the international standards of auditing. So, for example, under ISA 315 and 330, the company should assess risks annually and respond with more appropriate audit procedures. Management's override of controls must be prevented by introducing checks and balances and reviewing journal entries. Continuous auditor education on ISA compliance is also essential, as these measures help not just in identifying fraud, but also in building an internal control system that discourages fraud in the first place. Let's look at some key takeaway for auditors. The Toshiba scandal is a very important and necessary case to observe for any auditors, as it offers important learnings for any auditors and corporate leadership alike. For auditors, the case reiterates the need for independence and professional skepticism while performing audits, especially in risk-prone or pressure-prone atmospheres, such as was the case in Toshiba. If they are willing to put trust in management and fail to question any inconsistencies they find, the audit will fail and their reputation will suffer. Now let's look at from the corporate perspective. The corporate lesson is for an environment of ethical conduct characterized by transparency and accountability. Internal controls must be adequate, evaluated regularly, and enforced properly. There should be active participation of the board in governing the organization and supporting strong internal audit function in the process. The second last part that I would like to focus on and would like to iterate as the most crucial in Toshiba's case is an active whistleblower policy. The whistleblower protection, codes of ethics, and disclosure of conflicts of interest are all important safeguards to uphold their integrity. The last part that the case stresses on is that every stakeholder that integrates is never an option, and good internal controls are critical to long-term maintenance, even in the road to financial success. In conclusion, neglecting internal control systems and value systems is dangerous, and the absence of a healthy internal control environment and the lack of oversight serve to enable financial misstatements. The consequence of the scandal would prove dire for Toshiba and the entire Japanese corporate environment in terms of both money and reputation, as this case raised many red flags not just for the company itself, but for the Japanese national corporate governance systems in place. The breach of ISA such as 315, 240, and 265 reiterates how important it is for auditors to remain vigilant and for companies to have sound internal control structures. And any lesson learned from Toshiba scandal should be a lesson implemented in auditing in action for any companies by tightening their internal control structures, and auditors should fine-tune their fraud risk approach and become more transparent and trustworthy with their findings. The Toshiba scandal is a true reminder for when a company lacks internal control, it is inviting disaster and is leading to not just financial loss for the company. And we'll just move on to the next slide, and my peer will take over.
Good afternoon everyone, my name is Rohit Kumar. Here is the case number 5, which is Satyam Computer Scam 2004. Here comes the first slide, which is introduction. Satyam Computer Scam, often called India's error, was one of the most shocking corporate frauds the country had ever seen. It came to light in January 2009 and evolved Satyam Computer Service Limited as well-known IT company founded by Ramalinga Raju back in 1987. The business world was stunned by when Raju openly admitted that he had been faking the company's account for years, to tune of whopping 7,136 crores. To keep up illusion of success, Raju had doctorate financial statement, pumped up revenues, faked bank balances, and even created imaginary assets. The next slide is key players. Who was involved in these cases? The first is Ramalingan Raju, the owner of the company and who founded the Satyam Computers. The second was B. Ramaraju, the managing director of the company. And the third one was Srinivasa, who was the chief financial officer. The third comes internal control deficiencies. Top management had too much of unchecked powers, lack of independence in board and audit committee, weak check on financial reporting, auditors relied too much on management, no proper system of fraud detection, overconfidence in technology and automation. The next slide is discovery and investigation of Satyam's scam. In January 2009, Satyam's founder Ramalingan Raju shocked the nation by confessing a letter that he had falsified the company's financial records for years. He admitted the inflating profit, fabricating bank balances and creating fake assets, all to keep up appearance of successful company. His confession came after investors and board of members raised concern about a failed plan to buy a real estate company linked to his family. This triggered DP. Once the truth came out, the government stepped in, dissolved the board and ordered a full investigation. Ramalinga Raju ordered and others were arrested and PwC auditors came under fire to their failure to detect the fraud. The next slide is audit failure and complexity. Auditors from PricewaterhouseCoopers gave Satyam a clean check year after, saying the accounts were accurate even though they were heavily manipulated. Second is, instead of asking tough questions or verifying the records independently, the auditor blindly trusted forward documents included fake bank statements. It wasn't just negligence, it felt like they looked the other way on purpose. PwC earned huge audit fees from Satyam, which may have made them less willing to challenge the company's leadership. The serious breach of trust highlighted the auditors, who are supposed to protect the public and investors, completely failed in their duty. The next slide is ISA violations. The first one is ISA 240, auditors' responsibility to detect fraud. The second is ISA 330, auditor's response to assess risk. The third one is ISA 500, audit evidence. The fourth one is ISA 505, external confirmation. The last one is ISA 230, audit documentation. Consequences. When Satyam's founder Ramalingan Raju confessed inflating the company's profit and assets for years, it was like a punch to the gut for investors, employers, and the Indian IT industry. Thousands of honest employees were suddenly faced with uncertainty, not knowing if they have a job or a company to return to. It was a painful lesson, but one that forced India to grow up and take responsibilities. The last slide, which is the conclusion. Satyam Computers scam wake up call for India's corporate and auditing world. It revealed unchecked powers, weak internal controls, and failure to follow proper auditing standards, and can lead to massive frauds. Not just on papers, but affecting thousands of employees, investors, and credibility of an entire industry. Ramalingan Raju confession exposed deep-rooted flaws in corporate governance and showed how even global audit firm can fail when ethical responsibility is ignored. This case highlighted the urgent need for stronger regulatory system, independent oversight and greater accountability from auditors and board members. Today, it continues to serve a powerful reminder that trust, transparency and ethical leadership and non-negotiable in any organization. Thank you.
Good morning, this is Mujtaba Fadhel and today I'm going to explain about internal controls, so frauds which happen in the internal control in the company. So today I have taken a very simple company, it's a very good company which was in fintech. So the company's name is IAF-A, as you can see over here. Okay, so where it started and all. So it started in 1999 and its headquarters are in Munich, which is in Germany. Okay, so the company was technically in fintech, it was risk managing mobile payments, like how we have nowadays GPays and all. They had that at the side a very pack and they used it. So now they were usually in credit card controls, goldsmiths, they were working with goldsmiths and all, which are really good. So the introduction of this case study is basically the IAF-A scandal. So it had really financing reports, so whatever reports they are producing has a lot of fraud in it. Because they were not able to track, so the business was expanded in the Middle East, it was even in parts of Europe. And apart from that, they were not able to control each and every part of the company. So wherever they were in the Middle East, they were not able to connect with them a lot. Because of that, they were not sure how much business is going on. Because of it, the reports which are given, it was having a lot of misquoting and fraudulence with it. Apart from that, the services which are provided by them, they were not up to the mark. So because of that, people were coming, there were some ups and downs happening with them. Because of that, apart from that, banking licenses and all had a lot of issues, and they had many risk management things which were they not able to give it up to the point. They were moving on with the global operations and all, so they were in Asia and in the Middle East and Africa and parts of Europe also. Apart from that, they had built a very big companies in the Europe and Middle East. So in the Middle East, they had acquired a lot of businesses, small businesses which were in lending firms and all. Apart from that, they had even taken some loans. So people who were giving loans in the Middle East, they had acquired those companies, given loans to them, and those were not comparatively coming in. So these people were actually in the middle, they had expanded in the Middle East, Asia and Africa. Okay. Apart from that, there were third party acquirers. So these people had acquired the other companies which are giving loans. So there were goldsmiths, there were many other big companies which are giving loans to other small shops and all. So they were actually taking all those, acquiring all those companies. Now, they had billions of funds in the merchants' fund, which it was in the trustees' account. So they were not able to take a track of it. If it is yet there, it is not there because the trustees were not allowing them, or there was some other internal thing which they were not able to control it very well. Now it is like who all were involved in it. So the CEO was actually involved in it. Then there was another CEO, so this is Jan. Then the CFO was involved in it. There was another managing director which had a really big hand because he was the person, or I would say he was the culprit who was not able to take the firm and not able to operate the firm. Now, internal control failures. So these are a few points I'm going to explain about failures, what are failures they had. Okay, so one was fake revenue and fiction cash. They were actually giving out fake calls or fake transactions that okay, they have jobs, they are getting income from it, but they were actually. Now if you were to see, there were many third party acquirers. Okay, so they had acquired third parties, so maybe they had given some of the wrong information to them. So the headquarters were giving wrong information, and in the end, it was having a lot of issues. Now we have big oversight over compliance. Now, when they were expanding, so they expanded very rapidly. So they expanded in the Middle East and all those African countries. So when they had expanded, they were not able to supervise at every place. So especially in the Middle East, because they had acquired other companies. So people who were already working there, they were continued over there. So they were not having make sure what all work is going on, if the work is going on well or it is not going on well. So that was one issue which they had faced a lot. Now the third thing is like failure of external audits. Now when you are running a firm, so you usually have a firm where you have an external audits being done. Now those external audits were not even done appropriately, which had a lot of issues. Okay, so there was like they gave a clean audit opinion over the decades. So when they were giving clean audit opinions, they were, the people, the company owners by themselves, they were not getting where they are doing the issues, where the issues are coming, and they are having losses and all. But they were not even giving to the public or showing the public that they are getting losses. So inadequate regulatory actions. So the German financial regulatory banner focused on more punishing criteria and short sellers and investing into the red flags. They were punishing people instead of like seeing what is the issue or who are the people who are exactly doing the issue instead of the others. Now the next is solutions. What are solutions they have given up for them? So reforms for the German finance regulatory system. So in Germany there is a regulatory system. So they were giving up some structural reforms. So they wanted like some structures where they were like, we want this work to be done at this time in this format itself. So they were able to regulate it, which it was a good term for the company, and hopefully they were able to. They should have taken that reform, and they might be able to conform. They won't be bankrupt at the end. Now, increasing auditors' standards. So there was some like monetary auditors' reports. So when they were actually so after some period of time, they should have just changed the auditor, because the auditor might not be capable of giving a proper report to them, so they were not able to know where the issue is. So changing the auditor would be like a really good option for them. So a mandatory changing of auditor after every 10 years could be a really good option. And if you go to see in India, so it's usually every 2 to 3 years you should change the auditor. It's many companies follow that after 3 to 6 years. Somewhere in the between they change the auditor. So they get to know more accurate reports about it. Now, but the third point is actually strengthening corporate governance. Now, improving transparency. So when an auditor tells you that okay, one thing is important and you should go in that thing and you should more find out, and then there might be some issue or he is highlighting some issue, so that issue should be like taken seriously and should be like explained or should be corrected. Instead, like not to like argue with the auditor or something and put the interruption. Strengthening the internal audit could be like, so whatever internal audits are going on, you should check on them. People check what all is there, what all is not there, and accordingly just like move on. Now there's improved whistleblower protection, enhanced protection and platforms for anonymous whistleblower. The companies are encouraged to establish hotlines and protocols for internal control. So there should be like a timeline and end of the thing. Like okay, after this, all the things should be covered up and on. So that's it. With the ISA violations, so what are ISAs or the international standards they have violated while doing it? So first is the audit evidence, second one audit evidence. So they were doing the third party audits and all, they didn't do it perfectly. So that's the one thing. Now there was some ISA 240, that was auditor's responsibility relating to the fraud. So if the auditor is doing some issue or the auditor is getting paid to do the fraud, so they might take some below the desk money and they do the fraud. That should be controlled and that should be done by the external auditor or the internal auditor. Both of them should be accurate and put the answers should be similar. We get comparison. The third ISA which they actually made was audit documentation. So whatever documents they are giving, so the bills, the receipts which they are giving, so they are having a lot of frauds in it, which were causing them issues. Okay, so they were not able to, even if the auditor was true, the receipts were false, and because of that the profits were high, but or just on papers, the cash, there was no inflow of cash. Now then ISA 315 identifies and assessing the risk of material misstatement. So the violation was EY failed to properly identify and assess the risk associated with the wildcard third-party acquired partners and offshore accounts. So whatever third parties were giving them receipts, so they didn't cross-check it, and because of that, they had an issue with it. So if they would have cross-checked it, they would have avoided that they are giving some statements showing fake profits, and if their profits are not income. So that's the thing. Now, IAF-A 30 is auditor's response to assess risk. Now, the auditor was actually not giving proper information and all, or what all modifications should be done, or what all changes that must be done in it. So because of that, they were not able to catch up with all the different countries where their company is working right now. So with this, I conclude by internal control must be independently tested and continuously improved, especially in companies with complex international operations. Auditors must maintain professional skepticism and avoid over-reliance on management representation. Regulators must act proactively and remain independent for political and corporate influence. Whistleblower and investigation journalism play a critical role in uncovering corporate fraud and should be protected and influenced. Thank you.
Now, let's take a look at the final reflections of this PPT. As you can see, collapse of internal control reaching devastating consequences. The investors and shareholders lose their trust in the company, and the company's reputation as a competitor in the market is gone.
Okay. And internal controls are not just formalities. They're vital to ensuring ethical behavior, promoting stakeholder interests, and upholding financial integrity.
Such as Enron, Southern Companies, Toshiba, Vedanta, Wirecard, and Ryko India has taught us that all of these case studies together should be a warning sign for future professionals and to learn from such mistakes.
And to also commit to building such systems to prevent any such breaches in the future.
And
Thank you.